Wait till the end. I'll tell you the one practical move that could protect your money while $13 billion plan unwinds. The headline sounds exciting. Carney launches $13 billion to build homes, but headlines don't give you the whole picture. I'm Thuc, your money guy, and with over 10 years helping Canadians with mortgages and housing plans, I'll walk you through what this $13 billion actually means, how it will be spent, who wins, who loses, and how I'd act if I were in your shoes. Spoiler, the dollars don't just turn into doors overnight. There's a lot of policy, logistics, and politics between now and your key in the door. So what exactly was announced? The simple facts. The federal government announces a new agency called Build Canada Homes and said it will be capitalized with an initial $13 billion to kickstart housing projects and related programs. That money is intended to lower upfront costs for builders, use public land for projects, and finance affordable homes at scale. The launch detailed include an initial push to build 4,000 factory-built modular homes on 6 federal sites, cities like Toronto, Ottawa, Winnipeg, Edmonton, and the agency said there's capacity to scale up across its portfolio to many more units. The plan also lists separate pots of money for rental, protection, and supportive housing. That's the elevator pitch. But the how, the when, and the real cost is where things get interesting. Okay, sounds great on paper, but is $13 billion enough? Who pays for it? Hang on, that's coming up. What the $13 billion will be used for? Here are the concrete pieces the government spelled out. Direct build on federal land. The agency will prioritize 6 federal cities to build about 4,000 factory-built homes as a first tranche, with much larger capacity across the whole federal portfolio. That means the government provides the land and helps manage construction to reduce risk for builders. Canada Rental Protection Fund, $1.5 billion. This money is designed to help community housing groups buy at-risk rental buildings and keep them affordable long-term. $1 billion for transitional and supportive housing. That's aimed at people who are homeless or at risk, paired with services like health and employment supports. Nunavut Partnership, and other targeted builds. Some of this funding is earmarked for Northern and Indigenous housing projects. Hundreds of units there will be part of the early plans. The 4,000 unit numbers is just a first wave on certain federal lands. The agency said it has the capacity to support far more units across the other land and through financing tools. So that $13 billion is meant to unlock more construction than the raw dollar total suggests. Here's the key question people keep asking. Does $13 billion mean $13 billion worth of homes? Or is it just seed money to leverage private money? The answer matters, and I'll explain why next. How the plan is supposed to work. De-risking, leverage, modular. Think of Build Canada Homes as a builder of confidence, more than a simple checkbook. The government says it will use public land and provide financing and guarantees that lower the upfront costs and risk for private builders. When the government reduces the land costs and shares early risk, private investors are more likely to step in. In theory, multiplying the impact of that $13 billion. That's the leverage idea. Second, they're emphasizing factory built and modular methods, and even mass timber innovations. These methods promise faster build times and more predictable costs if scaled properly. The hope is to create a new domestic industry that can deliver many homes faster than traditional on-site construction. Bottom line, the government wants to be a developer plus financier of first projects to show it can be done cheaply and fast, and then crowd in private capital to scale up. Sounds clever, but there's a giant if attached. If and mass timber can be scaled and if private capital actually follows. If not, you just got a very expensive pilot program. The political promise, doubling housing starts, and why that matters. Remember the bigger promise, Carney's platform talked about housing starts to roughly 500,000 units per year over time. That's a big headline-grabbing target. The country hasn't seen that many starts since the 70s. Why does that matter? Because Canada's affordability problem is largely a supply problem. If you can actually double supply reliably, prices and rent should come down over time. That's the theory behind this policy package. But the reality is that getting from a plan to 500,000 homes a year requires a lot more than $13 billion. It requires private money, factories, skilled labor, permits, and time. The $13 billion is step one, not the finish line. So when politicians say we're doubling, know that this agency is one tool in a much larger, longer fight. If this is useful, hit subscribe. I break down the real implications of these housing plans every week so you don't get blindsided. I'll keep this practical and no BS. Up next, the concrete pros and the very real cons. I'll show you the numbers people are using to cheer or panic. Pros. The good things this $13 billion could do. Okay, the good news first. There are some real upsides if this is designed and run well. Uses public land to cut a major cost. Land is a huge slice of the final price. Using federal land for housing can tens of thousands off every unit if done right. That's smart and immediate. Build supply quickly. If modular scales. Factory-made units can be faster. If invest in factory capacity, you can reduce on-site delays and weather risk. That could speed delivery. Protects at-risk rental and homelessness. The Rental Protection Fund and Transitional Housing Money are targeted at people who need help now, shelters, support, and saving risky rental buildings from flipping to market rents. That's important social policy. Creates domestic industrial capacity. If the government's push builds a Canadian modular industries using Canadian wood and materials, that's jobs and future export potential for the construction sector. Crowds in private capital, in theory. If the government reduces risk on early projects, private lenders and investors might finance more projects, stretching the $13 billion into a larger pot of investment. Those are real benefits, but only if execution is sharp, which brings us to the other side. If you are thinking, sign me up, hold on. Here are the cons that critics keep hammering on. Cons. The big risk and criticisms. Now, the worries is a long list of legitimate concerns, and some of them are already being raised by experts and industry groups. Critics pointed out that saying $13 billion and 4,000 homes looked odd at first glance. That math gives an absurdly high cost per unit. But the government's response is the 4,000 units are just the initial pilot on federal land, and the $13 billion is meant to support a much larger pipeline through finance and leverage. Still, the optics matter and critics call it sloppy messaging. Implementation risk and bureaucracy. Building at scale requires permits, local approvals, pipeline factories, and project management. Governments are not always fast or efficient at this. The Fraser Institute and other commentators worry about cost overruns and slow delivery. Skilled labor shortages. You can order units, but you still need trades to install them, hook up services, and finish sites. Canada already has a trade shortage in regions. That bottleneck can slow everything. CMHC and builders warn capacity constraints are real. Crowding out or distorting markets. If the government uses public land and big subsidies, private builders might wait for subsidies or shift their development plans. That can slow normal private development and create dependency on public programs. Some industry analysts voice this concern. Timing. Supply won't appear overnight, even with a $13 billion push. Shifting supply material takes years. CMHC data shows that housing starts are volatile and that builders are cautious in the short term. So don't expect prices to tumble next month. All of that means the plan is promising on paper, but risky in practice. And the outcome depends on how the government manages these operational risks. Let me give you a straight example so this stops sounding like abstract policy. The $13 billion could be used two very different ways, and those paths lead to very different results. Best case versus worst case. I want to give you two clear scenarios so this policy stops being theoretical. Best case scenario, smart execution. Government launches factory capacity with public-private partnerships. The first 4,000 units are built cheaply on public land, showing modular works. Private capital sees success and invests. The $13 billion leverages far more money. Municipalities cut red tape to approve projects faster. Over 5 to 10 years, supply picks up meaningfully. Rent stabilizes and the housing market eases. Result? Meaningful extra supply, lower rental pressure, new industry jobs. Worst case scenario, slow, costly pilot. The initial project faced delays and cost overruns. Private capital is cautious and doesn't follow in. Governments continue to spend, but the scale remains small. Skilled labor and materials costs spike during build-outs, pushing per unit cost up. Result? Political headlines, little long-term change. Wasted billions on pilots with limited reach. Critics and provincial commentators worry we could end up here. Which do you think is more likely? My read, the outcome will vary by project and by province. Success in one city doesn't guarantee national success, but success somewhere does make it easier for the rest to copy. Okay, so what does this mean for you right now? Whether you're renting, buying, or watching the market, what to do now? Here's what I tell people, plain and simple. If you are a renter, don't bank on rents dropping overnight. This program could help in the long run, but it won't flip the market next month. Save for emergencies and watch for local rental projects that might open up cheaper units nearby. If you are a first-time buyer, keep saving for a down payment and build your credit. If the government delivers real supply in your city, it will help future buyers. But right now, affordability is still tight. Consider neighborhoods where public land projects might be delivered that can be a future opportunity. If you already own, watch how local projects affect your market. Near future federal projects, there could be short-term construction noise, but long-term it might stabilize rent. If you are up for a mortgage renewal, think about locking a sensible rate. Don't gamble on policy quickly changing rates. If you are an investor or builder, study the agency's rules. There may be opportunities, but don't assume handouts. Be clear on timelines and risk-sharing terms. General money steps for everyone. Build a 3 to 6 month emergency fund. Keep debt reasonable. If you're career mobile, consider markets with stronger builder pipelines and decent jobs. Supply alone doesn't guarantee affordability if jobs aren't there. Bottom line, the $13 billion Build Canada Homes push is a potentially big move, but is an opening shot, not a guaranteed solution. The good news is the government is finally treating supply like a priority. The bad news is that turning policy dollars into thousands of livable, affordable homes is complicated and slow. If you want a short takeaway, this is promising, but be skeptical of quick fixes. Watch how the first 6 pilot sites perform. They'll tell us whether this turns into a genuine supply engine or an expensive photo op. If you found this useful, hit subscribe. I'll track the Build Canada Homes rollout and give you plain language updates as the project moves from paper to dirt to doors. I'm Thuc, your money guy, making money simple, smart, and stress-free.